I want to thank everybody who chose to join us today during their lunchtime today. We have a chance to kind of go over the Tax Cut and Jobs Act update. This was a law that was passed towards the end of the year and is one of the most, one of the biggest changes we've seen in the tax law for some time. Now, as we go through here, I think in my career as an accountant, I have not heard as much in the media and press as I ever have about this, being positives, negatives, etc. And it's one of the things that kind of makes this law unique relative to previous changes in the law that I've seen is how it affects everybody slightly different. You're going to see when we go through this that there's a lot of times that there's benefits to some, and other times there's going to be benefits that are taken away depending on your own unique circumstance. So because of that, when we go through that, when clients ask me, you know, how's this going to affect my taxes? The answer, which you're going to, you know, people always love when accountants say this, is it depends. It depends on your own personal situation. There are some people who are definitely going to see large benefits. There are others who will see less benefits. And there's even a segment that is going to see their taxes possibly even go up. So we'll address all that as we kind of go through step by step in this and talk a little bit about each thing and what it might mean for you. But the key thing with all this is, you know, is this a good bill? Is it not a good bill? It's going to depend on who you are. And how it affects you individually. So let's start and jump right in to the presentation. We'll start off here. This is kind of our outline for today. First, I'm just gonna tell you really quickly a little bit about myself. Part two, we're gonna talk about time frame and tax brackets and how those have changed. Part three, we're gonna talk about key provisions within the law. And then the fourth, we're going to talk about miscellaneous deductions and other changes at the very, very end of this that are going to be effective. So that's kind of our outline for the next hour to be wrapped up here by 1. And like I said before, if you have any questions, type them in the question box. I will do my best to answer them at the end if there's time, but whatever questions we don't get to today, my plan is that I will email everybody out those answers later if you have any questions. So let's move on. A little bit about myself. My name is Jim George. I'm the owner of James A. George PC. James A. George PC has been in business for about 13, 14 years now. I myself, I'm a certified public accountant. I'm also a certified valuation analyst, and I'm also an attorney as well. My background, I've been working with taxes for almost 20 years, and our firm, like I said, has been around for about 14. That's a little bit about me. So let's talk first a little bit about time frame and tax brackets. First, most of the provisions become effective, and as a typo there, that's January 1st, 2018. I'm sorry. Yes, that's correct. January 1st, 2018. I'm still running a year behind. Most provisions became effective January 1st, 2018. What this means is that your taxes that you're getting ready to file this April 15th are unaffected for the most part due to this new tax law. What we're talking about now is the taxes that you're going to be filing next April, so April of 2019. So all the taxes all the changes we're going to talk about will not affect your income tax return you're getting ready in the next month or two to file. One of the things that we're doing for a lot of our clients this year, you know, because of these drastic changes, is that part of our preparation this year, if our clients want us to, we're actually going to run their tax return as to what it looks like in 2018 so they can get an idea of how much these changes will affect them. Most of the provisions for the individuals end January 1st, 2025. And what that means is that in 2025, if Congress would not act and do nothing, everything's going to revert back to how it was in 2017 for the most part when it comes to individuals. So when you've heard probably on the news about how the individuals, this all changes in the next 7 years, if nothing is done, everything will revert back to the way things were January 1st, back in 2017. On the flip side, which we're not going to talk much about today when it comes to the businesses, most provisions for the businesses are permanent, meaning those those are going to be permanent going forward. So that's one of the big differences. The individuals is temporary, the businesses is permanent. Now, whether they actually end up reverting back is probably not likely. I remember the big tax bill early in my career was the Bush tax cuts, and those, a lot of those had the same kind of thing. I think most of the time they were 10 years and then they would revert back. And then as time came closer and closer, Congress ends up acting to allow a lot of those provisions to stay even past that. But the key thing in this is, as of today, they revert back. So what we're talking about here is pretty much a 7-year period, but the provisions for the businesses are permanent. So let's take a look at the tax brackets, because the tax brackets are the one thing that's kind of the overreaching thing that I want to kind of keep in everybody's back of their mind when we talk about the gives and takeaways with everything else. Because while sometimes it may seem like you're getting a big benefit or that they're taking a big benefit away, the key overreaching thing is that everybody in the end is going to pay less from a bracket standpoint. And so when you look at the brackets now and how it was under the old law and for the new law, you're going to see that every single bracket's going to see a reduction with the exception of the 35%. So when you go back through these, you're going to see the 10%, 12%, 22%. So in the end, everybody's going to get some sort of break. So the more money you make, the more of a break you're going to see from a real dollar standpoint. But on average, if you look through, you're going to see that it's a 3% for those under the 25%, and then 4% for the 28, and then it becomes less. It comes down back to the 2 and 3% for the others categories. So in the end, overall, once we calculate what your taxable income is, if your taxable income was the same in 2017 versus it is in 2018, you'll end up paying less tax. The devil in the details, though, is how do we calculate taxable income? And everything else that we're going to talk about is how are we calculating taxable income? Because that may change. What your taxable income is in 17 most likely will not be what your taxable income is in 2018. So many cases with a lot of our clients, what we expect to see is that the brackets are down, but their taxable income is actually higher. So that ends up meaning that true 2%, 3%, 4% break is not as big as it looks. Some of our clients, on the other hand, may find that their taxable income is actually smaller, meaning they're going to see huge breaks because in the end, they're going to get only that 2 or 3%, but their taxable income is going to be actually less. So and again, I go back to what I said at the very beginning of this. A lot of this is going to be very much dependent upon what is it that is your circumstance relative to the law. So that's the key thing we go through this. But overall, I guess keep in the back of your mind, my tax income brackets are less than what they were. Okay. So the next section is the key provisions. We're going to kind of go through all the different changes. A lot of these have been talked about a lot in the media, and a lot of them have not. And so we're going to kind of go through and talk about some of these changes. So we're going to talk about unearned income of children. We're going to talk about standard deduction, personal and dependency exemptions. We're going to talk about the individual health care mandate, the child tax credit. We're going to talk about 529 plans. We're going to talk about itemized deductions, and then itemized deductions down. A lot of this is going to be about those itemized deductions, mortgage interest, state and local income tax deduction, charitable contributions, how things have changed, medical deductions, alimony, and then alimony and other deductions. We're going to kind of get into some other areas that are a little bit unique. So that's the plan today, to kind of go through those from the key provisions. So let's jump right into those. So for all these sections too, I'm going to kind of tell you what the old law was, just a little bit background behind it, and what the new law and how it's changed. So the first thing we're going to talk about is unearned income of children. So previous to this law, and so if you're filing your return in 2017, if you have children who have unearned income, which is not an unusual thing. A lot of times parents will give their kids stocks, those types of things, in the hopes that they could tax at a lower rate some children also receive gifts, those types of things. They have savings accounts set up in their names by grandparents, relatives, etc. And the IRS understood that this was the case, that there was a way of shifting income from parent to the kid. So prior to this, there was these special tax rules that were known as the kiddie tax, and they apply to the unearned income of the child if the child had not reached the age of 19 by the close of the taxable year, the child's unearned income exceeded $2,100, and the child does not file a joint return. Because in some, because of the fact that we have the child that's reached the age of 19, you could have a married child at the age of 18, etc. And also with that too, it's not just the age of 19, but if the child's a full-time student under the age of 24 and the parents were alive. So what would happen under the old law is that the income above 2,100 was not taxed at the child's rate, but it's taxed at the parent's rate. And that, again, that's a way to avoid how this gets shifted, this income that you could shift it to the kids. Instead of letting them do that, it's going to get taxed at the parent's rate. So that was how it was done previously. Now, under the new law, they changed this. And in this case, the earned income now is taxed under the rates for not for single the earned income is taxed under the rates for single individuals, and the unearned income, which is what we're talking about. And I guess let me go back and real quickly define unearned income. Would be essentially what it sounds like. You're thinking of dividends, interest, those types of things that are something that the child's not going out and earning. For instance, if you have a 16, 17-year-old who babysits, mows lawns, those type of things, that's all earned income, and this is not applicable whatsoever. We're talking about the unearned portion, which is like your interest, dividends, those types of things. But the new law says that the unearned income now is taxed according to the brackets applicable to estates and trust. The big deal with this is estates and trust tax brackets go up much quicker than individuals. So at the end of the day, what it will likely mean is that if you have children who have unearned income and who have been previously subject to the kiddie tax, that amount they pay will essentially be larger than probably what it was. So when it comes to thinking about planning for this, is if you have kids, this whole idea of shifting it into your children now has went from no benefit to possibly a detriment to what you've had. So this is obviously a law that's been enacted to keep people from doing this and shifting this into their kids' hands, so that it not only like I said, now it won't matter, but now it's actually, you can end up paying more tax than if you would have kept it yourself. So that's the change in an unearned income of children. The next change is about capital assets. So capital assets, let's talk a little bit real quickly what a capital asset is. A capital asset is something that gives rise to a capital gain or loss from the sale or I'd start back with the definition of capital gains. Capital gains or losses that come from the sale or disposition of a capital asset. The key thing here is that capital gains are generally taxed at a lower rate than ordinary income rates. So for instance, if you sell a piece of stock that you've held for more than a year, the rate you will pay on that gain is generally less than if you would have went out and earned the money and had it through earned income. The key thing in this though is the IRS does not have a definition to what a capital asset is. What they basically have is they provide us a list of what items are not capital assets. So for instance, things like inventory of a business is not a capital asset. Things that are held for sale as part of a business, they define as not a capital asset. So basically, if it's not something that they've said is not a capital asset, it is a capital asset. So the big change in this year is that coming up in 18 is that they've added some things that they said are no longer going to be considered capital assets. And those are patents, inventions, models of designs, and secret formulas of processes. Those are 4 things that historically have been considered capital assets that now no longer will be, meaning they're now going to be taxed at ordinary income tax rates if you sell those for a gain. I don't know how much that applies to a lot of people, but it's for those who do, this is a pretty significant thing, just because those things typically sell at much larger gains. And so that's why it is a big deal for those who it does apply to with those capital items. All right, let's talk real quick about the standard deduction, because I think this, of all the different things we've talked about in the tax, is definitely the one that our president's been promoting and the media's been talking a lot about. But at the same time, I don't think that everybody completely understands it and what it means. So let's talk about it for a few minutes. So under the old law, everybody got a standard. You had the option, and I guess it's still the same today. You have the option, once you calculate your adjusted gross income, of then either deducting a standard deduction or itemized deductions. The old law said that the standard deduction was for $12,700 if you were married, filing joint, and you see the other amounts on your screen for the ones that, if you're head of household, unmarried individuals, and married individuals filing separately. Under the old law, then obviously you also had the option to itemize. The new law, it has almost doubled the amount of a standard deduction. Now, while this sounds great, and it is great for those who have been using the standard deduction historically, we're going to see that there's also going to be some takeaways that they've been used to too in the next couple of slides. But the other thing that's why this matters is because there are a large group of people who have been itemizing their deductions instead of taking the standard deduction, that are in between that $24,000 and $12,700 using the married example. So let's say, for instance, you have been itemizing historically, and of your itemized deductions, you had mortgage interest, you had real estate taxes, you had charitable contributions, and those types of things. And let's say, therefore, you had itemized deductions of $24,000. For your tax return now in 2018, it's no different than what it was, because now you're going to be either take the standard or the itemized. You're still only getting the $24,000. You're not seeing any benefit whatsoever to this doubling because you were already itemizing. So I guess that's the key thing in all this, is the benefit of how much it is to you of this doubling is going to depend, well, what was your itemized deductions prior to this law? Now, if you were taking the standard deduction, you're going to be in better shape because in the end, you got it doubled. But the one piece of this that I think that we're going to talk about here in a few minutes, that is how we've done away with the personal exemptions, that in the end, it's not as big of an increase as it sounds. But the key thing with all of this is that it has doubled. And so this will keep playing into, again, we're going to talk about a couple different things. But the true question of how much this benefits you is, have you itemized in the past? And if you have itemized, what was it? Because if your number was 18,000, you're going to have 6,000 less than income this year of taxable income. If it was 22,000 last year, you're only going to get a benefit of 2,000. If you were over 24,000, you're the same, because you're still going to be able to itemize, assuming that everything you were itemizing before is still deductible, because a lot of things now aren't. So I guess that's a key thing too with this. You might have itemized, you might itemize in 2017, and in 2018 not be able to itemize even if you're over 24,000, because certain things you were deducting are now no longer deductible. So let's move on to the next slide. Like I said, the fact is many people will not itemize and therefore will lose the benefits, mortgage interest, those types of things. So, the real effects of this is, which I find very interesting in all this is that historically, things like mortgage interest have always given people incentive to go out and purchase homes, for instance. And with this, unless you have a large amount of mortgage interest, there's going to be a lot of people now who are going to fall into the standard deduction that we're itemizing. And by doing that, effectively, there's no benefit to owning a home versus renting, because you're going to be in the same exact position either way when it comes to purely, if you're looking just at the tax side of things. There's other factors to consider, like appreciation of property, et cetera, that still make it more valuable possibly to own. But the key thing here is a lot of the tax incentive might have disappeared with this law, The other thing that I find is going to be interesting, and to see how people is, I think the people that are close to that $24,000 threshold, is that a lot of people, a big part of the itemized deductions is charitable contributions. And a lot of people that, at the end of the year may sit there and say, I want to give $4,000 of, to different charities, because they know that if they have an average tax rate of 25% or a 25% tax bracket, that effectively that they only really will have $3,000 come out of their pocket to give $4,000. But if all of a sudden now I'm in the standard deduction, if I give away $4,000, there's zero tax benefit to it, meaning I'm just giving $4,000. So the question a lot of people are asking is, is how much of giving was tax driven? Not that people don't want to give, because in the end, whatever you gave away, you were still going to end up with less money than if you wouldn't have given. But the question is, in that scenario I gave, will people only give $3,000 instead of $4,000 because the intent was only to give $3,000, but they could give $4,000, and because the net effect was them only giving $3,000 because they were getting $1,000, essentially less tax that they'd have to pay. So it's going to be interesting to see how much this actually incentivizes. Is there less incentive to give to charities? We're going to talk about it later, though. When it comes to high income taxpayers, there actually could be more incentive to give. So this is kind of interesting that if your income's less, there's less incentive to give. If your income's more, there's more incentive to give. When we'll talk about that a little later when we talk about phase outs of deductions. So the next thing we're going to talk about, and this is the one I think that it flies under the radar though. So we talk a lot about the doubling of the standard deduction, but there are two different amounts that we subtract to arrive at taxable income. And everybody's only talking about, for the most part, the first. So under the old law, you had not only your standard deduction or your itemized deductions you took, but you also had personal exemptions. So basically every single person got $4,050. That's how much it is in 2017 that they could earn without paying any tax. And every single person got $4,050. Now, if you made over $313,800 for married filing jointly people, or $261,000 for individual filers, that would start phasing out. So you never got the personal exemption anyways if you're a high income taxpayer. But those who were in the lower income did get $4,050 per person. So what that means now is, remember I told you that this whole doubling of the standard deduction is great because we went from 12,000 up to 24. Remember that every married filing couple is now losing $8,100 worth of exemptions. So because the new law says the deduction for personal exemptions is gone, there is no more personal exemptions. So while you might have seen a $12,000 increase in your itemized deductions, you've lost $8,000 in your personal exemptions. So if you're a family also that has a child, you would have another $4,050. You're now in the same place that you were. If you, now part of this will be offset by the increase in the child tax credit, which again, we'll talk later. But this is back to what I said at the very beginning of the presentation. There's a lot of give and take. So we're going to give you more through doubling of your standard deduction. We're going to take away with the personal exemption. Now, the problem is if you're a person that was itemizing $24,000, your benefit of the doubling of the standard was zero, but you lost your personal exemptions. So just looking at those two alone, you're now in a worse position than you were before you started. And that's where I'm saying this is all, you're a worse position, but then I said, remember back at the beginning, keep in mind all the tax rates are less. So in the end, then you still benefit maybe overall. It's just going to depend on your circumstance. So if you're a person who did the itemized before, or standard deduction before, you're getting a benefit through that, but then you're losing it through the personal exemptions. And if you're a person who has multiple children, from just a pure exemption standpoint, you're going to have a lot less because you might have been used to taking 4 or 5 exemptions if you had 2 or 3 children. So this is the one thing that I find it's interesting that we talk about the doubling of the standard deduction, but we don't talk about the fact that the personal exemptions are going away. Next thing we're going to talk about is individual healthcare mandate. So everybody has heard, I'm sure before, that you know that everybody's required under the old law to be covered by a health plan that provide at least minimum essential coverage. And that if you didn't do that, you were required to pay a shared responsibility payment, which was, you know, basically what was called, people thought as the mandate. The key with this one is the new law beginning December 31st, 2018, the amount of the individual shared responsibility payment. It's funny, they didn't necessarily get rid of it, but the responsibility payment is equal to 0. So therefore, effectively, there is no shared responsibility payment. So therefore, there's no reason that you need to have under the new, the mandate's effectively gone, because if you do not have health insurance, there's no shared responsibility payment that you have to have. The questions that still exist out there is, are you still going to have to prove coverage? Because the fact that they didn't get rid of the responsibility of having health insurance, it's just there's no penalty for not having it now. So, you know, for when it comes to tax time, do you still have to show and check the box saying you do have health insurance or not is still a question, because in the end, it really won't matter. So let's move on to the next section, which is going to be the child tax credit. And this child tax credit is going to be is going to help negate part, if not all, of the personal exemption issues that we talked about, of losing those for the exemptions for the kids. So under the old law, you get $1,000 credit per child. But the key thing is, for a lot of people, if you filed a joint return and you made over $110,000 as a family, your child tax credit began to get phased out and you didn't get to take the full $1,000. So a lot of people, especially living here in Massachusetts, who are joint filers, found that they weren't getting the full benefit of the child tax credit because, you know, a lot of people make over $110,000 as a family unit. So therefore, they didn't get the full benefit. Under the new law, this $1,000 has been doubled to $2,000 per child. But the key thing that I think is important, that I don't think you hear a lot out in the media, is that the phase out doesn't begin until you hit $400,000 of income. So you'll notice that if you're a higher income earner, this is something that definitely skews in your favor, because if you are, for instance, below that $110,000 threshold, your child tax credit went from $1,000 to $2,000. But if you're a earner that, let's say your child tax credit was phased down to $600, but you're less than that $400,000 limit, you now saw an increase of $1,400 from $600 to $2,000 in your child tax credit. So if you earn more, you actually might see more of a benefit than someone who makes less, because previously you were getting limited and now you're not. So this is a key point of this. The other part of this that's important to mention, if you are lower income, and you don't have any tax due, the child tax credit is what they call refundable. And what a refundable credit means is that regardless of whether you're paying tax or not, you can actually receive a refund. So if your tax bill is, let's say, 0, but you still have a $2,000 child tax credit, a credit that you could have used against your tax, the government will still send you $1,400 towards that $200, because it's a refundable portion. It's not that you have to actually have tax. So it's one of those things that I feel that's is a big benefit for those between that $110,000 and $400,000 of income as a family, because they're going to see a lot more on the child tax credit side. Because the other reason that also benefits those who make more money is because those people were the same ones that might have been having their exemptions been phased out anyway. So they weren't getting the benefit of having the children as an exemption anyways. And now they're getting the full benefit of the credit. So overall, this is something that's great. It'll be good for all, but it definitely benefits those who make more than those who make less. The next part to kind of go along with the child theme is we're going to talk about 529 plans. and that there's one little change in this. I guess one change that is important to bring up. So 529 plans, for those of you who don't know, are savings plans that allow parents to put away money for savings for college. And typically it depends. There are state plans, and every state does things a little bit different. The key thing is for federal purposes, federal income tax, there's no deduction for putting the money away. It's different than if it's a retirement account. But the key things is then the earnings that earn in the 529 plans stay in the plan. You don't pay tax on those earnings. And then if you pull them out to pay for college expenses, then all of a sudden that money becomes tax-free, the earnings on it. So it's a good plan for many, many people. But the issue always has been too, if a child, let's say you start saving up for your child and then the child doesn't go to college, you always have the ability to transfer it from one child to another one beneficiary to another beneficiary. And the tax-free transfer only applies to one transfer within every 12-month period. So you can't be switching it multiple times. But the big change in the new law is that the new law allows for a distribution of up to $10,000 in connection for expenses for tuition incurred during the year in connection with enrollment or attendance in a designated beneficiary at a public, private, religious, elementary, or secondary school. So basically, if you have a child who can go, can go, let's say you want to start having some of that savings, you want to pull it out, and you want to send them to a private school, a religious school, you now can send them to it in, you can pull that money out tax-free, the $10,000 per year, to the public, private, or religious elementary school instead of having to wait to take it out for college. So I feel like this incentive is a great benefit, and it may encourage people to start putting money in 529 plans earlier, especially if they think they might be sending their kids to private school. All right, itemized deductions. So the first one here we're going to talk about is just the kind of the overreaching part with itemized deductions. So remember, we're not going to itemize our deductions now unless if we're married filing jointly till we're over the $24,000 limit, because now the standard deduction is now higher than it was. But in 2017, if you had itemized deductions, they started getting phased out at $313,800 if you were married. And what that means is that a percentage of your itemized deductions were taken away from you. So basically, the higher the income, the less you got to deduct. The new law in 2018, there is no income limit. So again, this is another provision that you're going to see is going to primarily apply to higher income people. Because at the end of the day, if you were prior to this law, when you had an itemized deduction, if you were over $313,800, you started to lose some of your itemized deductions. And now in 2018, you can earn as much as you want and you still get your itemized deductions. So as I said here on the effects of change, based on this, the change and the doubling of the standard, it is likely that only higher income taxpayers are going to be able to take advantage of these itemized deductions. It's because if you are lower income, or I would call it lower to mid, the chances are you're going to start using the standard deduction. But if you're a higher income person, you now have the ability to take a lot of those itemized deductions that historically you may not have. So that's the key thing with the itemized deductions. So we're going to talk now for a little bit of the actual itemizing themselves and some of the changes. And you're going to see in this is definitely going to fit the category of what we talked about earlier, a lot of takeaways, meaning things you used to be able to do that now you won't be able to. So under the old law, interest on mortgage loans up to $1 million in indebtedness were deductible. So if you had a mortgage that was $900,000, the interest on that home loan, the mortgage, was deductible. In addition, if you had a home equity loan on your house, up to $100,000 of debt was also deductible. So you were able to take, if you went out and got a home equity loan to do some improvements on the house or for whatever reason, you were able to deduct that interest. Starting in 2018, if you have the mortgage interest on mortgage loans only goes up to $750,000. So if you owe more than $750, you're going to lose part of that interest deduction that you previously were taking. So essentially, we're talking about mortgages between $750,000 and $1 million. So that will only affect probably most likely higher income taxpayers, that they'll get less mortgage interest. The next part, though, is the part that's the real takeaway, I believe, is that home equity loan interest is no longer going to be deductible. So anybody, no matter who they are, if you have a home equity loan, that interest is no longer going to be deductible. So it's less incentive to go out and get that home equity loan from a tax standpoint. Typically, home equity loans are less interest than other things, so they still think there's going to be a lot of people who want home equity loans, but the tax benefit of it now is no longer going to be there. Which again, we keep talking about a lot of these, you're going to say, oh my gosh, if I was itemizing, my itemized deductions now are getting smaller and smaller, which is why more and more people are going to find themselves in that new standard deduction. The next big piece, which you probably have heard a lot about, is the state and local income tax deduction. And under that, under the old law, taxpayers can deduct state and local, right now how it is, you can deduct your state and local real and foreign property taxes. You can deduct your state and local personal property taxes, and then you can also deduct your state and local foreign income taxes. You know, and the option 2 for states that didn't have those taxes, and there are some, taxpayers have the option to also elect and deduct their sales tax in place of the state and local income tax. So if you lived in a state that had no income tax and you did not own property, you, for instance, in a state like states like Florida or Texas, I believe, you would elect to do the sales tax. The new law, though, says that the only way you can deduct all those taxes fully is if they're in connection with carrying on a trade or business activity or related to expenses for the production of income. And what that basically means is, unless I'm actually conducting business and those taxes are related to that business, they're not deductible. So from an itemized deduction standpoint, though, if you have state income taxes, if you have property taxes and all those things you've been used to deducting, there's a limit of $10,000 for those taxes. So many people will find, especially in a state like Massachusetts, depending on the town you live in, how high your property taxes are, you're going to have a reduction in the amount that you get. So, because you might be paying, let's say, $7,000, $6,000, $7,000 worth of income taxes and another $5,000 or $6,000 in property taxes. You know, you might have been deducting previously $13,000, $14,000 in property taxes. Now you're all of a sudden going to only be able to deduct 10. You know, that combination. So it's in total. So like I said, depending on whether if you own your home or not, that will affect you differently. Many people who do not own homes and don't have property taxes to speak of, but their income tax is less than $10,000, they won't notice this at all. So this is one that actually I think will negatively affect homeowners more than it will non-homeowners. And again, you're going to hear this, you've been hearing this the whole time, this common theme of it affects everybody different. And if I think there's one group that has been negatively impacted by this law to a certain extent, which is just interesting because historically Congress has always put a priority in it, it definitely negatively impacts homeowners. Because all of a sudden your mortgage interest, you can't deduct as much of that. You have less incentive to itemize, and you can't maybe deduct all your property taxes now. So those are all takeaways that have happened in this law. Let's talk next about charitable contributions. So under the old law, if you made donations to a college or university where the taxpayer received the right to purchase tickets to an athletic event, you could deduct part of it. I believe the amount was 80% you could deduct. As you know, and we're not talking about an exchange tickets. We're talking about many large universities. It's the right to purchase tickets. And in this case, now you no longer can make those deductions. You can't deduct that as a charitable contribution. But the big change in the charitable contributions that I think is the most important, and it's most important to kind of tell you about today, even though we're not filing our taxes under the new law till next year, is that no deductions are going to be allowed for charitable contributions of $250 or more unless the donor substantiates the contribution by a contemporaneous written acknowledgement obtained from the donee organization indicating whether the charity provided any good or service to the taxpayer in consideration for the contribution. What that statement means is you're used to sometimes getting something in writing from the donor saying, I gave X dollars to this organization. If that amount is $250 or more to that organization, you must have documentation from the organization you donated to in order to take that contribution. Previously, you could not have it as long as you had documentation yourself that you had not received anything in return, and that you had paid the money. So that is a big change, because now you're going to need to collect those statements, make sure you save them for your own records. So if you're a tax client of ours and you come into work, we'll keep copies of all those things, but the main thing is that starting in 2018, you're going to need to in order to take those deductions. I think this is a way that they're trying to basically, it's not that you can't deduct, it's not that you're going to get less benefit for it, but the key thing here is I think they just want to make sure that people aren't taking charitable deductions when they actually didn't give anything. And by having a written requirement, it's going to make it a little bit more difficult. Medical deductions for 2 years, and this one's interesting because it actually does affect 2017 and 18. This is one of the only things that affects 17. The threshold for deducting medical expenses is decreased from 10% to 7.5%. And so what I mean by that is that previously under your itemized deductions, everything, so once you calculate what your adjusted gross income is, and I'll use easy numbers. So let's say your adjusted gross income was $100,000. You were able to deduct medical expenses that were above and beyond 10% of your adjusted gross income. So therefore, I'd say if you have $100,000, if you could deduct any medical expenses over $10,000. This now is 7.5%, so now it's anything you can deduct over $7,500, and that's just for the 2 years. That being said, the key thing I wanted to mention for those of you who might actually be paying alternative minimum tax, for the purpose of that calculation, it's still 10%. So it's only, and to be honest with you, very, very few of my clients actually take medical deduction because the bar is so high to get over. For instance, let's say if your bar was $10,000, you had $11,000 worth of medical expenses, you're only actually deducting $1,000, that difference. It's not once you get over 10, you get to take it all, it's the difference. Another big change that I don't think is getting much attention is alimony. So under the old law, when two people get divorced, the person who's paying the alimony is deducting it, and the person who receives the alimony claims it as income. And the thought process behind that is that the person receiving the money it's their income, and the person who has to give their income away to the other spouse, that person it's not their income. The key thing in this is the new law says for any divorce or separation agreement executed after 2018. So therefore, people who are still getting divorced in 2017 will follow the old law. Is that basically alimony is not going to be deductible by the payer, and it's not going to be included by the recipient. So basically, it's going to be whoever earns the original income, and alimony is not going to be deductible. And we work with a lot of family law attorneys here at our firm, and this is one that is going to cause headaches because a lot of times the incentive to give more in alimony is the fact that they get that deduction and now they no longer are. So it's going to make things interesting in the divorce world as to how they're going to handle this. Because even in Massachusetts, we have things like the alimony law. There's certain percentages and things like that that apply to that, but they are taken into account partially under the old law of how things will be from a taxable standpoint. So that's going to be interesting on how that all plays out. The other thing too to keep in mind with this is, if your agreement is before December 31st, 2018, and we go into 19, you are still following the old law. You're still deducting it, and you're still claiming it as income. It's only for those who get divorced after 2018. So it's only for new agreements. And again, this is going to be one of those things that's going to be fun to see how the IRS actually is able to track this and enforce it, because they would have to know the date you were actually divorced. Couple other things we'll mention, some other deductions that I think are, that are important to probably a lot of you, is that there was an elimination of some entertainment, meal, and transportation expenses. They're eliminating some of that. The one that I think is very big, because we do see a lot of it here, people moving into the area, there's the suspension of the moving expense deduction. So previously, if you moved a distance and for work purposes, certain moving expenses were deductible. And starting now with the new law, those deductions are no longer allowed. There are a few limited situations, primarily to the military, that they are, but for the most part, they are been suspended. So that's one of the things that's going to be, I think, affect people that they may not think about until they actually go to move, and all of a sudden that moving deduction is not there anymore. The other big thing is it eliminates all the miscellaneous itemized deductions. So for those of you who have been used to deducting your safety deposit fee, and the one that everybody kind of finds kind of funny, or deducting the price of having someone prepare your tax return, that's gone. So yes, before you could deduct someone to do your tax return, and now you can't. So now you have to pay it, and you don't get any kind of benefit for even paying it. Now, most people weren't getting the full benefits of those itemized deductions because they, similar to the health, to the medical deductions, they were subject to a 2% floor, meaning it had to be over 2% of your adjusted gross income. And many people were never taking those deductions anyways. But for those who were, they're now gone. So I think that's the key thing. It's another thing to take away. So, as we went through this whole deduction section, I think the key thing in all this is that you now are most likely going to, you're going to use the standard deduction a lot more than you used to. I'm not saying that everybody is universally now going to the standard, but I think there's going to be a large group of people who now are going to move to the standard deduction. And I also think from year to year it could change because of this. Again, it's going to change on what your circumstance is. Couple things that I think we're going to talk about real quick when it comes to income that I just thought were interesting and that I thought I would put in here. The moving expense reimbursement. So we talked about how before moving expenses previously were allowed to be deducted. And only way you wouldn't deduct it is if you got a reimbursement, because many times people move and the employer that's hiring them is paying them to move. So historically, you couldn't take the deduction, but that moving expense reimbursement was not included in income either. The change in this is if your employer reimburses you for your moving, you now include it in your income. So now you have to pay tax on that money. So it's just something to consider, that if you're ever thinking about switching jobs from a distance and they say we're going to reimburse you for your moving expenses, that's great, but the benefit's not as great as it once was because now you're going to pay tax on that income. And the other change that's in here that I thought was just humorous as to what in the world Congress was thinking. If you get reimbursed for bicycle commuting, before those were considered non-taxable reimbursements, and now those are considered income. Why I think that's funny is that it didn't suspend the reimbursements for parking or using mass transit or van pools. So basically they are saying you have to claim for income if you ride a bicycle instead of mass transit. So I think that's kind of, the thing that's funny is that someone doesn't like bicycles that throws something like that in. They remove just the one piece, but they didn't remove the rest. So it's just kind of interesting the way they did that. And then the last piece we're going to talk about real quickly, and we're just going to kind of breeze over this because it doesn't apply to as many people as it does others. The other big change, there's changes in how recharacterization of Roth IRA contributions can be done. So therefore, if you're contributing to a Roth and you realize you can't and you need to recharacterize that contributions, there's changes in how that's done, and that's fairly complex. So we're not going to get into that today for our 1 hour today. There's some changes in time to repay loans from your retirement plan. So if you have a 401k plan and you need to repay it and then something happens, you're terminated, there's some changes in time and you actually get some extensions to pay that off and different things you can do to make it a little less likely that you're going to end up paying income on that. But there's some changes in that. Everybody's heard about the estate tax changes and how they're increasing the limits on the estate tax. That only applies to high income people that have large estates. So those changes. The other change, I'm not going to just get into that much just because from its complexity, is there are some changes to the alternative minimum tax exemption amount. And with that, it's just how they're handling that. And again, that's something it's mostly for higher income people that they're dealing with AMTs, even though the alternative minimum tax seems to be hitting more and more people at lower incomes these days because of the fact that previously, before this law, was not getting indexed for inflation. So every year as people made more money, the limits stayed the same. And then the other thing I'm not going to get into today because it's more business related is the 20% deduction for pass-through income. That if you're a pass-through income, there is going to be this new deduction. Essentially, this is the way of giving the benefit for people who own businesses. And again, this is something that's a little bit more complex, and we could talk for a half hour on just this piece. And later, we're going to do something. We're going to have another one of these webinars for people who are interested in that piece only, just to talk about that piece. So that is it for the slides I have today, and that's the major pieces that will affect most people with this tax law. There are some other little, this is a 400-some page law, that there are little other things, but this I think is the big things that everybody can be affected. So I guess in conclusion, what I kind of want to reiterate to everybody is whether this is good or bad for you is completely going to be dependent upon your circumstances. And year-to-year circumstances, it may change whether it's good or bad. And, I think the best thing that everybody can do is plan ahead for next year, understand how this affects them to make sure that they're withholding correctly throughout this year. If you're working for someone or paying estimated tax payments, and for those of you who own businesses, to make sure that it's going to come out in a way, because the one thing that I still in my own mind have not completely understand is starting this month, they're changing the withholding tables to put more money in people's pockets, but depending on your circumstances, how big of a benefit you're actually going to receive. So one of the things I'm concerned about with my clients is just making sure that they're not going to get ginormous refunds or end up owing next year. I'd rather see them adjust their withholding so that they can have the money throughout the year in their paychecks, and at the end of the year have either a tiny refund or owe just a teeny amount that they get it pretty close to zero come tax time. So I want to thank everybody for being on this today. We're sitting here right about 1, and I want to thank everybody for joining us today. If you want to go back and hear this later in the next week or two, this will be up on our YouTube channel. So I'd encourage anybody who joined us late, if you want to go back and re-listen to the beginning of it. I'll also make the handouts available for everybody too, if you want to get those as well, and we'll put those up on our website. So again, I don't have much time left here, but we'll talk about that later. And I do see that there is a question, and I will email that answer out to them later today. But thank you again, and I look forward to talking to you all soon. Bye.